What if I told you that most Americans before 1900 never had credit cards, never took personal loans, never financed cars, never lived paycheck to paycheck, and yet somehow they managed to survive economic crashes, financial panics, harsh winters, illnesses, and uncertainty, while slowly building stability and wealth over time, many of them even dying completely debt-free. No apps, no banks on every street corner, no buy no pay later buttons. Just strict money rules so powerful that if people followed them today, entire industries would struggle to survive. And once you truly understand how Americans handled money before 1900, you will never look at debt, savings, spending, or success the same way again, because America before 1900 was a world where money was physical, slow, and limited. Coins had weight, bills had value. Every purchase was intentional because people lived close to the land as farmers, craftsmen, shopkeepers, railroad workers, and laborers who depended on seasonal income and unpredictable conditions. And if you didn't have money in your hand, you simply did not buy anything. There were no safety nets, no government bailouts, no unemployment checks, no social security, no health insurance, and no forgiveness for financial mistakes, which meant survival itself forced discipline. And the first and most powerful rule everyone understood was that debt was shameful, not normal. Unlike today, where debt is casual and encouraged through credit cards, student loans, car payments, and endless monthly subscriptions. Before 1900, debt was dangerous because failing to repay did not hurt a credit score that could be repaired later, but it destroyed your reputation permanently. Neighbors stopped trusting you. Merchants refused to sell to you. Banks closed their doors. And in some cases, families lost land, tools, and homes that had been passed down for generations. Debt made you dependent, and dependency meant weakness, and weakness during economic hardship invited disaster. Which is why people avoided borrowing aggressively and only turned to credit as an absolute last resort. And even then, credit was personal, not automated. It came from a local store owner, a family member, or a trusted neighbor who knew your character and your work ethic. And once you broke that trust, it was gone forever. There was no reset button, no second chance. So Americans lived by a brutal but simple rule that if you could not pay cash, you could not afford it. Houses were smaller, furniture was repaired, clothing was mended again and again, tools were sharpened instead of replaced. And luxury was never financed, but earned slowly over time. Saving money was not optional either, because there was no protection from bad luck. Illness failed, crops, workplace injuries, or economic downturns. Savings were survival. Families saved before upgrading their lives and often kept emergency cash hidden inside walls, buried in jars, or stored as gold and silver coins, not for investment, but for security. Because comfort was temporary, but preparedness meant the difference between stability and ruin. Money moved slowly, and that slowness protected people from emotional decisions, because without instant transactions, people had time to think, to hesitate, to reconsider, to ask whether a purchase was truly necessary. There was no impulse shopping, no dopamine-driven spending, no late-night purchases driven by stress or boredom, and that delay forced discipline, which quietly built wealth over decades. Every dollar had a purpose, and budgets existed long before spreadsheets or apps, because families tracked food costs, seed purchases, tool repairs, livestock expenses, land payments, and seasonal income carefully. Money was never abstract. It represented hours of labor and physical effort. Waste was considered irresponsible and even immoral. Children learned the value of work and money early by watching their parents struggle. Save and plan, not through financial influencers or online advice, but through daily life, and history shows us that. Whenever these rules were ignored, disaster followed. Financial panics like those in the 1800s wiped out. People who borrowed heavily, speculated recklessly, or chased fast wealth, land was lost, businesses collapsed, and families were broken. While those who lived modestly, saved consistently, and avoided debt survived and often emerged stronger by purchasing land or assets cheaply. After crises, home ownership meant something very different before 1900, because it was about stability, not status. Mortgages were rare, down payments were large, repayment periods were short, And if you could not afford a home outright, you waited patiently, which meant fewer homeowners but stronger ownership. Foreclosures were uncommon because people simply did not buy what they could not truly afford. Wealth during this time was slow, quiet, and unglamorous. Land passed from generation to generation. Skills increased in value with age, businesses grew over decades, not quarters, and no one expected instant success because time itself was understood as the greatest wealth multiplier. This mindset reduced anxiety, reduced comparison, and reduced reckless financial decisions. But everything began to change in the early 1900s when banks expanded. Aggressively, consumer credit became easier. Advertising exploded, and debt slowly transformed from a last resort into a tool and then into a lifestyle. Payments replaced ownership, convenience replaced patience, and the old rules that had protected people for centuries quietly faded away, giving birth to modern financial stress, chronic debt, and constant anxiety. And the uncomfortable truth is that most Americans before 1900 were not rich by modern standards, but they were free. Free from constant payments, free from monthly bills stacking endlessly, free from compounding interest working against them. Their lives were physically harder, but mentally calmer, because financial survival was built on control rather than dependence. And the rules that protected them did not stop working, we simply stopped following them. Which brings us to the most important question of all. If Americans once built stability without credit cards, loans, instant approval, or easy money, what would happen if we tried to bring even a few of those rules back today? Would people regain control over their finances, reduce stress, and build real wealth again? Or would the modern system collapse under the weight of discipline and patience? That is the question history leaves us with. So comment below and tell me which of these old money rules you think still applies today. Like this video if it changed the way you think about money. And subscribe to Finance Ted Official because sometimes the future of wealth is hidden in the forgotten rules of the past.